The $200 a month. Investing blueprint from zero to hero. Let me ask you something. Is investing just $200 a month a complete waste of time?
Because a lot of people seem to think so. You see the gurus online flashing huge returns, talking about 10xing thousands of dollars, and then you look at your $200, and it feels like a drop in the ocean. You look at the vast, intimidating stock market and figure, why even bother? I'm telling you, that hesitation is the single biggest mistake keeping most people from ever building real wealth. And that thinking is dead wrong. In this video, I'm going to give you the exact blueprint to turn that $200 a month from a why bother amount into a powerful engine for wealth, taking you from zero to financial hero. This isn't about gambling or chasing risky bets. This is a smart step-by-step plan that perfectly balances safety with explosive growth. By the end of this video, you won't just believe that $200 is enough. You'll have a clear, actionable path to turning it into a six-figure, and yes, eventually even a seven-figure nest egg. Stick with me, because we're about to debunk a major myth and build your financial future, starting right now. The proof. Why $200 is a fortune in disguise. All right, before we get into the nitty-gritty how, let's talk about the why. Why am I so fired up about your $200 a month? It all comes down to a little piece of magic called compound interest. I know, you've probably heard the term thrown around, but I want to show you what it actually means for your money. Compound interest is basically your money-making babies. It's the snowball effect. Picture a small snowball at the top of a very long hill. As it starts rolling, it picks up more snow, getting bigger. As it gets bigger, it picks up even more snow with every single rotation. Your initial $200 is that snowball. The profit it earns is the first layer of new snow. Next month, you're earning interest not just on your new contribution, but on the interest you've already made. But talk is cheap, right? Let's run the actual numbers. Let's say you invest $200 every month and we'll assume a conservative 7% average annual return, which is historically pretty reasonable. After 5 years, you've put in a total of $12,000, but your account wouldn't be worth $12,000. Thanks to compounding, it would be worth over $14,500. You've made $2,500 for doing nothing. Not bad, but we're just getting warmed up. Let's jump ahead to 10 years. You've contributed $24,000. Your balance? Over $35,000. That's more than $11,000 in pure profit. Your snowball is getting bigger, and it's rolling faster. Now let's look at 20 years. You've put in $48,000. Your portfolio is now worth over $105,000. You've officially more than doubled your money, and the growth from your investments is doing most of the heavy lifting. But here's where it gets wild. Stick with it for 30 years. You will have invested $72,000 out of your own pocket. Your account balance could be over $244,000. Over $172,000 of that is pure passive growth. Your tiny snowball has turned into an avalanche. And if you follow this blueprint and average a slightly higher return, like 8 to 10%, those numbers can get truly astronomical. This is the proof. This is why you can't afford to think $200 isn't enough. It's the seed for an entire forest of wealth. You just have to plant it and give it time. So now that you know the incredible power you're holding, let's get into the plan. The blueprint. Step 1. Build your foundation, okay? You're convinced. It's time to build. The very first step, before you buy a single share of anything, is to build the garage for your new wealth-building machine. You can't just buy stocks through your bank. You need a specialized brokerage account. Specifically, a tax-advantaged retirement account. This is where you'll hear intimidating acronyms like Roth IRA and traditional IRA. Don't let them scare you. Think of them as two different buckets to hold your investments, and the main difference is how Uncle Sam gets his cut. A traditional IRA is tax-deferred, meaning you might get a tax break on the money you put in today. Your investments grow year after year without taxes, but you'll pay income tax on everything when you pull it out in retirement. This can be great if you think you'll be in a lower tax bracket when you retire. A Roth IRA is the opposite, and for most people starting out, it's a financial superstar. You put in money you've already paid taxes on, so there's no tax break today. But, and this is the beautiful part, your money grows completely, 100% tax-free. When you withdraw it in retirement as a qualified distribution, generally after age 59.5, and having the account for 5 years, it's all yours, tax-free. You pay taxes on the small seed today so you don't have to pay taxes on the giant harvest later. For this blueprint, we're focusing on the Roth IRA because that tax-free growth is just too powerful to ignore. Imagine that $204,000 we talked about. With a Roth IRA, every penny is yours. With a traditional IRA, you'd owe a pretty hefty tax bill on that. So, how do you open one? It's shockingly easy and takes about 15 minutes. First, pick a brokerage. These are the companies that provide the platform. Think of big, reputable, low-cost names like Fidelity, Charles Schwab, or Vanguard. You can't go wrong with any of them. Second, go to their website and click Open an Account. You'll select Roth IRA. Third, you'll fill in your personal info, name, address, social security number. This is standard and required by law. Your money is incredibly safe with these big companies. Finally, you'll link your checking account. This is how you'll move your $200 each month into your new investment powerhouse. That's it. You now have your own personal wealth-building machine. Seriously, don't put this off. Once the account is open, you've officially graduated from thinking about investing to being an investor. The Blueprint Step 2, the core. Your first $150 in safe, steady growth. Account open? Check. Now for the fun part, putting your money to work. This first move is the foundation of your entire strategy. We're taking the bulk of your money, $150 of your $200, and putting it into the reliable workhorse of your portfolio. Our goal here isn't to hit a home run. It's to get on base every single time. We want consistency, reliability, and diversification. And the absolute best way to do that, hands down, is with a low-cost S&P 500 index fund, or ETF. Let's break that down. The S&P 500 is simply a list of the 500 largest, most dominant public companies in the US. We're talking Apple, Microsoft, Amazon, Google, the giants of the American economy. An index fund just buys and holds all 500 of those companies to mirror the performance of the whole market. So why is this our rock-solid starting point? First, instant diversification. By buying one share of an S&P 500 fund, you own a tiny piece of 500 different companies. If one company has a bad year, it's balanced out by the other 499. This massively cuts down your risk. Second, it's proven. Over the long term, the S&P 500 has historically delivered average returns of around 10% a year. It's a bet on the entire US economy, which has been a pretty fantastic bet for more than a century. Third, and you need to lean in for this, it's dirt cheap. Index funds charge a tiny annual fee called an expense ratio. Look for funds with an expense ratio of 0.05% or lower. That means you'd pay just $5 a year for every $10,000 you have invested. A 1% difference in fees might not sound like much, but over 30 years, it can cost you tens or even hundreds of thousands of dollars in lost profit. You must keep your costs low. You'll see these as either mutual funds or ETFs. For a beginner, either one is a great choice. ETFs, exchange-traded funds, often have slightly lower costs and can be easier to trade. So here's your mission for Step 2. Log into your new Roth IRA, transfer your funds, and set up a purchase of $150 into a low-cost S&P 500 index fund or ETF. Look for tickers like XAX, SJPPX, or VO. With that one move, you become a part owner of the 500 most powerful companies in the country. This is your safe, reliable engine for creating wealth. The Blueprint Step 3, the accelerator, your $50 for explosive returns. Okay, your solid foundation is built. Now it's time to add the turbocharger. This is the hero part of our Zero to Hero blueprint. We're taking that remaining $50 and we're going to give it one job: to hunt for explosive growth. The mindset here is critical. This is a calculated risk. We're only using 25% of our monthly investment, so even if this part underperforms for a while, the stable core of your portfolio keeps you right on track. But if it performs exceptionally well, it can shave years off your journey to wealth. So what are some options for this accelerator? One great strategy is to invest in a more focused, growth-oriented ETF. A perfect example is a NASDAQ 100 ETF, which often trades under the ticker QQQ. This index is packed with technology and innovation-driven companies. It's more volatile than the S&P 500, but historically it has also delivered periods of much higher returns. Another option is to look at thematic ETFs. These are funds built around long-term trends you believe in, like artificial intelligence, clean energy, or robotics. They're more specialized, but they offer a way to invest directly in the future you're excited about. A third option, and this one requires the most homework, is to use this $50 to start researching and investing in individual stocks. This isn't for everyone, and you should never buy a stock just because you saw it on social media. But if you're willing to learn how to analyze a company, this can be incredibly rewarding. Your choice here should match your own interest level. The NASDAQ 100 is a simple step up in risk. Thematic ETFs require you to believe in a trend. Individual stocks demand a commitment to learning. Whatever you choose for your accelerator, remember the golden rule. This is your offensive player, while the S&P 500 is your solid defense. Together, they create a balanced team designed for long-term victory. The blueprint step 4, automate and forget. This final step is the easiest to set up, but it's psychologically the most powerful. This is the move that guarantees your success by protecting your portfolio from its own worst enemy, your emotions. The final step is to automate the entire process. Every major brokerage lets you set up automatic recurring investments. You're going to go into your account and tell it to automatically pull $200 from your bank account every single month, maybe the day after you get paid. Then, you'll instruct it to automatically invest that money into your chosen funds. $150 to the S&P 500 and $50 to your accelerator. Why is this so non-negotiable? First, it makes investing effortless. Life gets busy. You'll forget. You'll put it off. Automation ensures your wealth engine is always running in the background. Second, it forces you to use a powerful strategy called dollar cost averaging. By investing the same amount each month, you naturally buy more shares when the market is down, when prices are cheap, and fewer shares when it's up, when prices are expensive. This removes the impossible burden of trying to time the market. Finally, and most importantly, it takes your feelings out of the equation. The market goes up and down. There will be scary headlines and market crashes. Your human brain will scream, "Sell," when things look bleak. Automation is the circuit breaker for panic. It forces you to stick to your rational, long-term plan, protecting your future self from your present self's freakouts. This set it and forget it approach isn't about being ignorant. It's about being disciplined. Your job isn't to obsess over the daily market swings. Your job is to trust the plan you put in place and let the system work. And that's it. That's the 4-step blueprint to turn $200 a month from a waste of time into a wealth-building machine. Step 1. Build your foundation with a Roth IRA. Step 2. Invest your $150 core into a simple S&P 500 index fund for steady growth. Step 3. Add your $50 accelerator into a higher growth fund to supercharge your returns. Step 4. Automate the whole thing to enforce discipline and remove emotion. The path from zero to financial hero isn't paved with complex strategies or getting lucky on a risky bet. It's paved with consistency. It's built brick by brick, $200 at a time. The numbers don't lie. The power of compounding is real, and it is ready for you to use.
You don't need to be a Wall Street genius. You just need a plan and the discipline to stick to it.
Now you have the plan. There's a famous proverb, the best time to plant a tree was 20 years ago. The second best time is now. Don't let another month slip by. Your future self is begging you to start today. Open that account. Set up that transfer. Plant your seed. If this video gave you the clarity and confidence to finally start your investing journey, do me a favor and hit that like button and subscribe for more no-nonsense financial content.
And I want to hear from you in the comments below. What has been the single biggest thing holding you back from investing until now?
Let's talk about it. Thanks for watching, and here's to your financial future.